Hello, so we're going to have a look at this exam question focusing around regulation of financial markets. So the specific question is, evaluate the importance of the regulation of financial institutions within an economy. So obviously when we're talking about financial institutions, we're thinking about commercial banks, investment banks, retail banks, so on and so forth. And we're looking at why it's important for them to be regulated. So, first off, we can outline some of the main purposes and reasons for regulating these institutions. Main purpose. So the reason that we want to regulate these specific financial institutions is we want to ensure protect customers. Because we don't want customers to be exploited by the financial institutions, and also the reason there is regulation is prevent collapse of firms, in this case financial institutions, as well as the whole sector. Obviously, in today's society with globalization, the risk of a whole sector collapsing is significant due to the interconnectedness of such firms. And then we can give some examples of regulation. So, the Bank of England is in charge of looking after regulation of financial institutions in the United Kingdom. So, Bank of England has two specific bodies which are focused on regulation of financial institutions. So, the Financial Policy Committee is in charge of macroprudential. And what we mean by macroprudential regulation is we're looking at regulation of the whole sector. So the financial sector within the UK. Very much as obviously when we look at macroeconomics, we're considering the whole economy. Whereas microeconomics focus on individuals such as firms and households. And then the other body within the Bank of England is the Prudential Regulation Authority. And the Prudential Regulation Authority, as I alluded to earlier on, is focused on microprudential regulation. And what we mean by microprudential, as I again alluded to, is individual institutions. So microprudential, looking at individual institutions. And there are other regulators. So the IMF and World Bank have the financial sector assessment program. Basically what that does is it advises countries on necessary actions to take based on testing that the IMF and World Bank undertakes on the financial sector within that economy. So we've outlined at the start of our answer the main purposes of financial regulation, and we've given some examples. So that's a really solid start to our response, showing a real good understanding of regulation and specific examples of it. So let's really focus now on answering the question at hand and showing a real strong economic understanding. So we need to focus on the idea of why it's important to regulate. Okay, so point number one that we're going to talk about is it's going to ensure financial stability. So regulating financial institutions ensures financial stability. So we now need to explain why ensuring financial stability is important to an economy. So ensuring financial stability means, well, one element means financial institutions have necessary funds to lend. So ensuring financial stability means that financial institutions have necessary funds to lend, and therefore, as a result, firms can borrow. If firms can borrow, then obviously the firms are therefore going to invest, so there's going to be increased investment. What will that investment lead to? Well, that investment will lead to increases in aggregate demand and the long-run aggregate supply curve. Okay, and we can obviously represent that on a diagram. So, price level, real GDP. We'll insert our first long-run aggregate supply curve, introduce a new one. We'll have two AD curves, AD, AD1. We'll go LRAS, LRAS1. We'll just draw an arrow to demonstrate that shifting outwards. And then we'll add in our equilibrium point. So we had originally equilibrium there. And then it looks like there's a slight rise in the rate of inflation to there, based on our diagram. Okay, so what we see here is we see an increase in AD. We go from AD to AD1, and an increase in the long-run aggregate supply curve from LRAS to LRAS1. What do we see? We see an increase in real GDP from Y to Y1. What does that represent? Well, that represents an increase in economic growth. It also represents a decrease in unemployment, because as we know, there is a derived demand for labour. So when the economy is growing, there is a derived demand for labour. Obviously, that reduced unemployment is going to increase the GNI per capita, leading to an improvement in the Human Development Index. So again, that's going to lead to economic development as well. Economic development. Okay, so we've got economic development, we've got economic growth, and we do see a small increase in the price level from P to P1, and that represents a small little bit of inflation. Okay. But the key thing here is to focus on the aspect that the regulation of the financial sector ensures financial stability. It means financial institutions have necessary funds to lend. It means firms can therefore borrow those funds, and therefore increasing investment, which will improve aggregate demand and the long-run aggregate supply curve within the economy. And that is going to be important because it can lead to improvements in economic growth, reduced unemployment. It can lead to economic development. However, it may lead to a small bit of inflation. Okay, so we can see why regulating the financial institutions is important, because it ensures that the financial system is robust, it has the necessary funds to lend and ensure that economic activity can be maintained. However, we must consider to what extent it is going to be effective. So we may see that actually regulation may be too strict. Regulation may be very strict. And what we mean by that is that it may mean that institutions have to have a high capital ratio, for example. So strict high capital ratio. So what does that mean? Well, that means that basically the banks can't lend as much money because they have to ensure that they have enough capital at the bank as dictated by the regulator. The reason why the regulator may have stipulated that they have high capital ratio is because if there was a collapse, well, it should prevent a collapse because they would have the necessary funds to prevent the collapse from happening. But obviously, if they've got high capital ratio, therefore there's going to be reduced lending. And therefore there's a reduction in borrowing. So obviously, if the banks aren't lending, people can't borrow, and therefore we won't see a significant increase in aggregate demand and aid and long-run aggregate supply curve. Okay, so it's important to consider that obviously if regulation is particularly strict, then the banks won't lend. Also, we must obviously consider consumer and business confidence. Obviously, if consumer and business confidence are low, therefore there's going to be less borrowing as well. So it may be great that the financial institutions are well regulated and therefore they may be fully operational. But if people don't want to utilise the financial institutions for their primary purpose of lending, in order for people to borrow, then the regulation isn't going to be really important at all, because we need to consider how are people wanting to borrow. People don't want to borrow. It doesn't matter how well you regulate the system to ensure it provides one of its functions, and therefore it's not going to have an important impact on the economy. So that's one point we may wish to consider with necessary evaluation, which has been well explained at the bottom. Okay, now we want to look at some of the other reasons why it's important to regulate the financial sector. And what we're doing here, what we want to have a look at is we want to have a look at reducing the risk of financial crisis. And we may want to reference, obviously, the financial crisis of 2007-8. Financial 2008. So we want to reduce the risk of a financial crisis, one which we saw in 2007, 2008. Okay, if we reduce the risk of a financial crisis, what we're therefore going to preventing bank runs. So a bank run occurs when people feel like that they're going to lose their money, because if the bank's going to collapse, they fear that if they don't withdraw all their money quickly, then they're going to lose that money. So that's the idea of a bank run. It's the sense that people all suddenly run to the bank and look to withdraw all their money as quickly as possible. Obviously, the bank having all that money withdrawn from it can't then use it to prevent it from collapsing, and actually is going to cause further damage to the bank by doing so. So it's really important we regulate the banks, because if we can reduce the risk of financial crisis, therefore we're going to prevent any bank runs from occurring. And what we therefore do is it maintains consumers' confidence. So what we would see if we prevent a financial crisis, there's no decrease in consumer confidence. If there is no decrease in consumer confidence, there's going to therefore be no decrease in consumption, and therefore no decrease in aggregate demand. And as a result, what will happen is it maintain unemployment levels and also maintain economic growth. So by having the financial sector properly regulated, it will therefore ensure that bank runs do not occur. We can maintain employment levels or unemployment levels and maintain economic growth. And therefore there's no negative impact upon the economy because bank runs have been prevented. Okay. Also, obviously, when we think about bank runs and financial institutions collapsing, banks don't have to fire employees. Okay. Banks don't fire or sack employees. And therefore, if employees aren't sacked or fired, there's no increase in unemployment. We also therefore mean that there's no decrease in consumption and therefore no decrease in AD. And there ultimately we maintain unemployment levels and maintain economic growth as well. Okay, so banks don't fire or sack employees. There's no increase in unemployment, so therefore there's no decrease in consumption, no decrease in aggregate demand, and therefore unemployment and economic growth are maintained. And also, you could obviously mention there's no increase in government spending. So obviously, government spending would have increased with regards to on like things such as job seekers allowance, so therefore no increase in government debt, for example, because obviously they're not spending money on job seekers allowance if people did become unemployed. Also, we may want to consider, obviously, if we reduce the risk of a financial crisis, there's not going to be any requirement for there's going to be no increase in government debt. Okay, and obviously that's really, really important. So no increase in government debts because there's no bailout of banks required. So banks don't need to be bailed out. The government will not need to provide financial assistance if the financial institutions are properly regulated. So there are no bailout of banks, no government spending to prevent collapse. So obviously we saw banks such as the Royal Bank of Scotland receiving large amounts of government money in order to prevent it from collapsing. So obviously institutions being properly regulated, such as the Royal Bank of Scotland, the government doesn't have to spend money. Therefore, the government debt is not going to rise. What are the implications, and therefore why is financial regulation important? That no increase in government debt will mean that there would be no austerity measures. So obviously, following on from the 2007-2008 financial crisis, the UK entered a recession. One of the reasons that one of the reasons for that recession can be due to the austerity measures imposed by the Conservative government, with a focus on decreasing government spending in order to repay back the government debt. No austerity, no decrease in government spending, and therefore maintain economic growth and unemployment, for example. Also, the no increase in government debt is going to be important because it should ensure a strong credit rating. And therefore, in maintaining that strong credit rating, it keeps cost of borrowing low. So what should that allow governments to do? Well, it should allow governments, therefore, to borrow in the future, and they could use that borrowing to improve the long-run aggregate supply. So they can increase the long-run aggregate supply. So just to recap what we've talked about so far, we obviously talked about the main purpose of regulation of financial institutions. We want to protect customers and we want to prevent the collapse of firms as well as the whole sector. Gave some examples such as the elements of the Bank of England, the bodies within the Bank of England, and we looked at what the IMF and World Bank do. We looked at, obviously, ensuring financial stability is really important because it ensures that financial institutions have the necessary funds to lend, allowing firms to borrow and invest, and that would therefore increase economic growth and reduce unemployment, for example. But we did argue that if regulation was particularly strict, then banks may not lend because obviously they may have to keep a large amount of capital within them. And also, it's very much dependent on business and consumer confidence. We also consider that, obviously, regulating banks is really, really important for reducing the risk of financial crisis, preventing financial crises such as the one we saw in 2007, 2008. By preventing a financial crisis, it prevents a bank run. Okay, and therefore, by preventing a bank run, there's no decrease in consumer confidence, and therefore, consumption isn't going to fall and aggregate demand isn't going to fall. Banks don't fire or sack employees. Obviously, if banks collapse, their employees would have to be would also lose their jobs as well. So there's no increase in unemployment. Obviously, therefore, maintaining consumption and aggregate demand, and therefore maintaining unemployment and economic growth. Also, there would be no increase in government spending on job seekers allowance, for example, and therefore there would be no increase in government debt. And then finally, we talked about the government debt not increasing because banks won't need bailing out, and therefore there wouldn't have to be any austerity to follow, and therefore government spending wouldn't decrease, and therefore economic growth and unemployment can be maintained. And in addition, it would mean that the government debt not increasing would ensure that the economy would maintain a strong credit rating if its national debt to GDP was relatively low, and therefore that would keep cost of borrowing low in the future, and therefore that could allow governments to spend in the future with a low cost of borrowing, which they could use to therefore increase their long-run aggregate supply. Therefore, may want to do some spending on infrastructure, for example. So we've looked at some real benefits there. We may wish to have supported some of those arguments with relevant graphs. So, for example, the low cost of borrowing by maintaining strong credit rating. So we talked about could increase the long-run aggregate supply. Obviously, we can use a relevant diagram to talk about that point. Price level, real GDP, LRAS, LRAS1, outward arrow, AD curve, and then we can add in the relevant equilibrium point. And then we go from Y to Y1, and we go P to P1. So obviously we can explain why that's important. So maintaining the low cost of borrowing can result in a decrease in cost push inflation. So you've got the decrease in price level, P to P1, that's representative of a decrease in cost push inflation. And obviously you've got an increase in real GDP, Y to Y1, obviously representing increase in long run economic growth. And you've got a reduction in unemployment. So that was obviously a graph that you could have been used for the final point that we made about obviously government debt not increasing, and therefore the country or the economy maintains a low cost of borrowing for the future, and therefore that can allow them to invest in infrastructure, increasing the long-run aggregate supply curve, and obviously therefore having a positive impact on economic growth and unemployment, as well as reducing cost push inflation. And then finally, you also may wish to have used the aggregate demand not decreasing, but obviously showing if it did decrease what the impact that would have on the economy. So long run aggregate supply, real GDP, price level, we'll add in two AD curves here. AD to AD1, Y1, P1, decrease price level. Okay, so there would be prevent, decrease. So for example, we talked about decreased consumer confidence, decreasing consumption. Prevent a decrease in C, and therefore well, let's phrase it if it did happen. So if financial crisis occurred due to lack of regulation, then what would happen is there may be decreased consumer confidence, i.e. there's a bank run. Therefore, that would decrease C, that would decrease AD. You'd have a contraction along the long run aggregate supply curve. Obviously, the decrease in aggregate demand was from AD to AD1. There's a contraction along the long run aggregate supply curve. There's a decrease in real GDP, Y to Y1. There's a decrease in the price level, P to P1. Okay, so actually positive with regards to the reduction in demand pull inflation in this case. However, what we do see is we would see a rise in unemployment and a fall in economic growth, which is obviously negative. Okay, so we've talked a lot about the importance of regulating it, because it prevents this from happening. It could allow this to happen in the future, and it allows lending to take place as well. But obviously we must consider regulation has specific limitations, and we need to explore those in detail. So particular issues with regards to regulation, we've got lots of evaluation to potentially talk about now. So we've got regulatory arbitrage. So basically the banks change how they operate, or financial institutions change how they operate. So, and we've specifically seen in recent years a rise in shadow banking. The idea of it being shadow banking, it's unknown, okay, and therefore we don't potentially know the risks that it could cause. So banks change, shadow banking, potential risk of future crisis due to lack of standing and banks taking risks. So the idea is that banks change how they operate due to the regulation. The regulator doesn't know about how the bank is now operating, i.e. we've seen the rise in shadow banking, and that poses a specific risk that there may be a financial crisis in the future because of how banks have changed the way that they behave. Okay. We may also want to consider a number of other points with regards to higher bank funding costs. So what we mean by that is we mean that obviously banks have to follow certain rules now. And by following those specific rules, it's going to increase the cost for the bank. So due to the regulation, they've got higher costs. Okay, so what these higher costs are going to translate into is the higher costs are going to translate into lower returns for savers, and it's going to translate into higher costs for borrowers. And what those higher costs for borrowers therefore may mean is it may mean that therefore there is a decrease in borrowing, for example, and therefore that may lead to therefore a lower investment and therefore lower aggregate smaller increases in aggregate demand or a decrease in aggregate demand, and also therefore we may see a reduction in the long run aggregate supply. So obviously banks complying to the regulation may therefore have a negative impact upon borrowers as well as savers. The lower return for savers and therefore and higher costs of borrowing may have a negative impact upon the economy. Okay. There are other elements. The regulatory capture would be another point we could have mentioned. Obviously, when we talk about regulatory capture, we want to be considering the impact that regulatory capture has. We want to be considering that specific politicians and regulators can be susceptible to pressure from bankers, and basically the regulator changes the regulation in order to suit the institutions. So potential issue of regulatory capture, institutions lobby the regulator to change regulation to benefit themselves. And again, if regulatory capture does occur, then that would increase the risk of a financial crisis, because obviously they would lobby to basically to increase the financial institutions' profits. So that would increase the risk of financial risk, increase the risk of a financial, not financial risk, but a financial crisis. Also, we may wish to consider, obviously, the other issues that we may want to consider. We may want to consider moral hazard, for example, complexity, compliance and administrative costs. So there are other points that we may wish to, but those points were particularly fine. I think those are particularly good to talk about and expand upon. And then finally, all we needed in our response was a judgment. Is it important, financial regulation? Yes, no, why? There is no right or wrong answer. I would probably argue that yes, it is important, because it reduces the risk of a financial crisis, and therefore maintain economic growth and unemployment levels. And that would be my justification. Quite brief but simple. I've answered the question. Yes, I think it is important, and I've explained why. And obviously that's backed up by what I've talked about in the answer so far. And then depends on. Are there any factors that we need to consider? Is regulation really that important? Well, you could argue that financial regulation is important, but it may not necessarily be the most important. You may wish to consider other factors within an economy which are more important for it. Financial regulation is obviously going to be highly important if the economy particularly relies on its financial sector, because obviously if the financial sector does collapse due to a lack of regulation, then obviously the impact upon the economy is going to be more severe than if this financial sector was particularly small. So it depends on size of financial sector, and obviously we need to explain what we mean by that. So